Hi everyone, I am Deric. Welcome to my channel. In this video, I'm going to talk about behavioral finance. Efficient market hypothesis asserts that it is impossible to consistently achieve returns greater than those of the market, because all relevant information is already incorporated into asset prices, as stocks are always traded at their fair value. This theory assumes that markets are perfectly rational and efficient. However, some studies show that markets are not always perfectly efficient. Psychological factors such as fear, greed, and overreaction can lead to mispricing of assets. Investors sometimes make systematic errors that can be exploited for profit. This is the idea of behavioral finance, which proposes that psychological influences and biases affect the financial behaviors of investors and financial practitioners. The following are some facts in the stock market that contradict the efficient market hypothesis. First, investors who believe they have superior information tend to trade more, but earn lower returns. Second, investors tend to sell stocks that have risen in value rather than declined. Third, investors acting on emotions instead of facts may reduce market efficiency. Fourth, it may be profitable to buy underperforming stocks when they are out of favor. Fifth, momentum of stock prices up and down tends to continue over 6 to 12-month time horizons. Lastly, value stocks may outperform growth stocks. In the following part, I'll explain some common biases under behavioral finance which will affect the investors. First, mental accounting. Mental accounting refers to the psychological phenomenon where individuals mentally categorize and separate their financial resources and transactions into different mental accounts based on various criteria, such as the source of the money or the intended use of funds. These mental accounts are subjective and not necessarily rational. For example, someone might treat money received as a gift differently from money earned through work, even though both are essentially fungible cash. Mental accounting can lead people to make irrational investment decisions. For instance, they might invest in high-risk stocks with the money from a windfall gain because they consider it extra money, without considering the risk properly. Mental accounting can also affect an individual's spending habits. For instance, if someone has saved money in a specific account earmarked for a vacation, they may be more willing to spend it on the vacation, even if it might be more financially responsible to use it to pay off high-interest debt. Second, loss aversion. Loss aversion is a psychological bias in which investors tend to prioritize avoiding losses over seeking gains. They are often more fearful of losing money than they are motivated by the potential for profit. When faced with an investment that has declined in value, investors might hesitate to sell, hoping that the stock will recover and they can avoid realizing a loss. This behavior can lead them to hold on to losing stocks for an extended period. The longer investors hold on to losing stocks, the larger the losses they suffer. This reluctance to cut losses can lead to portfolio underperformance and missed opportunities in other investments. It's crucial for investors to balance the desire to avoid losses with the need to make rational decisions based on current information and market conditions. Third, overconfidence bias. Investors tend to be overconfident in their judgment, leading them to underestimate risks associated with their investment decisions. They may believe that their assessments and predictions are more accurate than they actually are, leading to a false sense of security. This is a tendency of holding a false and misleading assessment of our skills, intellect, or talent. In the context of investing, this means that we may believe we are better at analyzing financial markets or selecting investments than we truly are. Being overconfident in our investment decisions may interfere with our ability to practice good risk management. While confidence is generally seen as a valuable trait in various scenarios, when it comes to investing, it often becomes a vulnerability. Effective risk management is important for achieving success in investments. The overconfidence bias often causes us to view our investment decisions as less risky than they actually are. Fourth, self-attribution bias. Investors tend to attribute their successes to their own skill and expertise while attributing failures to external factors or bad luck. This bias often results in overconfidence in one's abilities when things go well, and a reluctance to accept personal responsibility for losses. As such, investors will only follow the information that supports their beliefs and disregard conflicting information. This can lead to a lack of objectivity in decision-making. Hence, it can lead to bad investment decisions, and investors tend to keep repeating the same mistakes. In other words, it can result in a cycle of poor decision-making and repeated errors. To avoid self-attribution bias, one of the most effective ways is by recording and reviewing a trading journal or investment log. It can help investors identify their strengths and weaknesses in trading, so that they are able to correct the mistakes and avoid repeating the same mistakes, ultimately make more informed and balanced investment decisions. 5th, representativeness bias. Investors frequently make the mistake of believing that two similar things or events are more closely correlated than they actually are. Investors may misjudge the probability of an event occurring because it appears similar to something else they are familiar with. This can lead to incorrect assessments of risk and return. In other words, investors tend to draw strong conclusions from small samples. Probably just based on 1 or 2 years of good company performance, investors may conclude that the company can achieve good performance in the future as well. But we have to remember, past performance may not guarantee the future performance. That's why investors prefer buying stocks that are familiar to them, without regard to whether the stocks are good buys or not. It is also called familiarity bias. For example, investors overallocate funds to familiar companies or industries and ignore other more promising investment opportunities. Therefore, investors tend to underestimate the effects of random chance. They may attribute success or failure to their own skill or the inherent quality of an investment when in reality, chance plays a significant role in short-term fluctuations in stock prices. 6th, narrow framing bias. Investors may react to a particular opportunity differently, depending on how it is presented to them. It is because investors tend to make decisions based on the way the information is presented, as opposed to just on the facts themselves. The same facts presented in two different ways can lead people to make different judgments or decisions. When investors are not sure of all the facts or in a situation where there are many unknown factors, the possibility of being influenced by narrow framing bias is also increased. They may focus on the limited information they have, potentially leading to suboptimal decisions. In other words, investors tend to analyze a situation in isolation, while ignoring the larger context. This myopic view can result in overlooking crucial factors that may significantly impact their investment decisions. 7th, anchoring bias. Anchoring bias is a cognitive bias where someone values an initial piece of information too much to make subsequent judgments. Consider an investor who initially buys a stock at a high price. Subsequently, when the stock's value drops, they may still hold on to it longer than they should, because they are anchored to the higher buying price. This anchoring on the higher purchase price biases their judgments about the stock's true value, potentially leading to financial losses. 8th, belief perseverance bias. It is also known as confirmation bias. A tendency of investors to pay close attention to information that confirms their belief and ignore information that contradicts it. Most of us have a bad habit of only paying attention to information that agrees with our existing beliefs. We also have a tendency to form our views first, and only look for the information that agrees with us. Because it feels good and warm to hear our opinions reflected back to us. That's why we tend to listen to people who agree with us. But the fact is that, ignoring the information that conflicts with our existing beliefs may limit our ability to make rational investment decisions. Instead, we should also look for contradicting information for making rational decisions. 9th, herding behavior bias. This is a tendency of investors to follow and copy what other investors are doing. Analysts may also be biased by herding behavior, where they tend to issue similar recommendations for stocks. They are largely influenced by emotion and instinct rather than by their own independent analysis. There is a large weight of evidence of herding mentality bias in the financial markets. People often find it emotionally or psychologically painful to go against the crowd. That's why we will always follow what people say and believe. Another aspect of herding effect is that investors or analysts may be overly optimistic about a favorite stock's future. That will cause overtrading and eventually overvalued stocks. Lastly, we can use behavioral finance to improve investment results. First, don't hesitate to sell a losing stock. Overcoming the reluctance to sell a losing stock can prevent you from falling into the disposition effect trap, where investors hold on to losers too long hoping for a rebound. Second, don't chase performance. Avoid the tendency to buy assets that have recently performed well, as this chasing returns behavior can lead to buying high and selling low. Third, be humble and open-minded. Recognize that you may have biases and that others' perspectives can be valuable. Stay open to different viewpoints and continuously learn from your experiences. Fourth, take time to do research and make a decision. Avoid impulsive decisions by thoroughly researching investments. Patience in your decision-making process can help you avoid rash choices driven by emotions. Fifth, review the performance of your investment on a periodic basis. Regularly assess the performance of your investments to make informed decisions. This practice helps you avoid the anchoring bias, where you stick with an investment despite changing circumstances. Sixth, don't trade too much. Excessive trading can lead to higher costs, taxes, and reduced returns. Be mindful of the overconfidence bias and trade only when there's a well-reasoned strategy, not out of impulsiveness.